Software as a service, SaaS, disrupted the long-established software industry, propelling Salesforce.com, Adobe, ServiceNow, PayPal, or Shopify as market cap leaders of the $172 billion cloud industry. And they're well on their way to dominate the $456 billion enterprise software industry at large. So what are the four key areas of change compared to the traditional on-premise software? How would you measure and optimize your SaaS business? That is what we want to cover in this very video. The biggest and foundational of the SaaS model lies in its licensing and revenue model. From a transactional one, license and maintenance, to a subscription one. It changes the entire dynamics from the customer lifecycle to revenue recognition, and as a consequence, the role of sales and support, now called customer success, as you don't help customers troubleshoot only, but rather you make sure they use your solution to the max and keep a smile on their face so they stay with you the longest time possible. It is a little bit like the mobile telco business model. You can tell how much all these players, these vendors, are fighting for your subscription, keeping you as long as possible as subscribers and increasing their service to raise what they call the ARPU, the average revenue per user. As a consequence, the nature of the customer relationship is very different from the one in traditional software, where the vendors would be in touch with the users only if something was wrong. Now, users are always connected to the vendor to use the solution. But the buying decision makers are not necessarily your users. That makes it even more complex. So you need to please both. Also, very powerful to capture feedback of the users, as you can analyze in real time what they do with your solution. And for a lot of SaaS solutions, not to say all of them, you can try it and buy it online in a blink. This is here I learned at Salesforce to get back to prospect on the web within the 10 minutes after their digital first engagement, at the risk of losing 80% of your leads otherwise. Learning the hard way. Your offered customer experience needs to be frictionless, immediate, and reflect your customer centricity, if not customer obsession, as customers are now in control and your competitor are just a click away. As an industrial, you need to change the paradigm of developing and delivering your software. In software, you do not have manufacturing plants and complex supply chain. Your assets are your research and development, R&D, and your hosting facilities. For your R&D, long gone are the big announcement of the impressive number of new features for the new version of the software, traditionally happening yearly at best. Now, you update all your customers at once, very often every quarter. Agile development and Scrum are paramount, with real-time, permanent user feedback loops. This is fast change is the new currency. As you also host everything on the cloud, best in one instance, your delivery model is optimized from a CPU, storage, and network by design. You don't need one server per customer served, but you need to be able to cope with peak consumptions at certain time of the year. End of the month for payroll, as an example, or Christmas shopping for e-tailers. And to complement this new paradigm, your solution needs to offer APIs, application programmatic interfaces, to be totally and seamlessly integrated with other cloud-based solutions. payment solutions for e-commerce platform as an example, or social network platform for CRM and marketing automation solutions. It's a connected world. Now that we have explored the key change factors, let's do a deep dive into success criteria and, more importantly, how to optimize your SaaS business. It's about financials, it's about financial KPIs, it's about customer experience KPIs, and it's also about the rule of the 40, which is mostly looked at by investors and shareholders. So, the first thing that you need to keep in mind is that you need to maximize and grow your net bookings. Net bookings are the addition of bookings coming from new customers, expansion bookings coming from existing customers, minus the churn, which is the customers you lost in the same period. That will give you the net booking. Bookings are the total dollar value of all new signed contract, measured through monthly recurring revenue or annual recurring revenue, MR or AR. With bookings, you want to include all items that are associated with revenue. When a customer commits to spending money with you, that's a booking. You need to adjust that number as the commitment changes, particularly in terms of downgrade and any churn. The key to getting accurate bookings metrics is to understand that it is an annualized recognition of revenue items coming into your business. So you want to execute any items that do not fall in that category. The reason for these bookings are tracking your committed momentum from your growing customer base. While recognized revenue will be different, remember that your booking are measuring where you're headed. Your product, sales, and marketing teams should be motivated by bookings to continuously develop an amazing customer experience with complementary features that line up with your value metric to increase committed contracts and make it as long as possible. Additionally, annual contracts are a wonderful way to boost bookings considerably. Now let's look at how to optimize that. And there are 3 ways to do that. But first, you need to understand what a value metric stands for. A value metric is the way a company measures the per unit value of their product for sale. A value metric example is keys, which are sold in pairs, as an example. In SaaS, if value metrics determine the pricing and subscription terms of a product. If you're Salesforce.com, Salesforce Customer Experience Software, you're charging for each seat per month. If you're selling MacBook Airs, it's each MacBook Air one time upfront. But if you're Salesforce, you're charging for CRM, customer service, by the user per month. And in this example, you see marketing automation that has two value metrics: the number of users and the number of contacts in your marketing automation solution. By aligning your product with a value metric, you ensure that the value you are offering are in tune with your customer persona and with each one of them. This in turn allows you to expand the amount of revenue your customers are committing to as their usage expands. You need to reduce the churn, and to do that, quantifying your buyer persona beyond a few clever names and slide decks, because you know your customer, you'll start to be able to identify where you can improve in reducing your churn. Churn is really the kryptonite you need to avoid in your business. In this graph, you can see the market segmented in 3, and in each market segment, the key personas and what are the kind of feature of your solution that are important for each one of them. This is where your job starts. optimize that. Make sure your customers are super satisfied and their pains and gains are to the max. Also, the longer you get your customer or prospect to commit to a contract, the longer and more your booking will rise. Work on making sure you're optimizing for longer contracts that expand on the value metric and reward the long commitment, because that's what you care about. So those are the 3 ways to this part. Now, let's look at the customer-centric measurement and optimization. There are 3 KPIs, each one reflecting a phase in the customer lifecycle: the discover phase, buy phase, consume phase, and advocate phase. To optimize all of them, the recipe is straightforward: trust, simplicity, and convenience. Let's look at the first one, customer effort score. It's the sum of all your customer effort score divided by the total number of respondents. For example, so if you get 12 responses, 3, 7, 5, 3, 7, etc., each customer would rate you from 1 to 7. So your customer effort score is the addition of all your customer effort scores divided by the number of respondents. The customer effort score ranges from 0 to 100. Your CS is the total number of customers who agree that their interaction was easy, divided by the total number of responses. For example, if you have 65 customers out of 100 rated you 5, 6, or 7 on the 7-point scale of your CS would be 65. Let's look at customer satisfaction. Your CSAT scores range from 0 to 100 as well. To calculate your score, take the number of satisfied customers, those who rated you 4 or 5, a little bit like when you're on an e-commerce site, 4 or 5 stars, and divide by the total of number of responses. For example, if 62 of your 100 responses have a rating of 4 or 5 stars, your score would be 62. The last one is your Net Promoter Score, NPS. It can range from a negative 100 to plus 100. At minus 100, it means every single person who responds is a detractor. They would not recommend you, and they're likely to leave bad reviews on your product or service. Your Net Promoter Score is calculated by subtracting the percentage of detractors from the percentage of promoters. The percentage of passives is not included in the formula. For example, if 10% of respondents are detractors, 20% are passives, and 70% are promoters, your NPS score would be 70 minus 10 equal 60. Now, let's close with the rule of 40. The rule of 40 is a very common metric used by private equity investors and strategic buyers to measure the performance of a SaaS company. Measuring the trade-off between profitability and growth, the rule of 40 asserts that a successful SaaS company growth rate and profit margin should add up to 40% or more. The rule of 40 can be a useful metric when comparing between SaaS companies. In addition to measuring, this metric is also a normalizing factor. For example, a company can reach 40% on a rule of 40 basis in many different ways. It can have 20% revenue growth and 20% EBITDA margin, or 0% growth and 40% EBITDA margin, or at the extreme other end, 40% revenue growth and 0% EBITDA margin. You start to understand the dynamic. Some companies may sacrifice profitability for growth, while others may be uber profitable but have not invested in growth factors such as sales and marketing. Using this calculation allows buyers and investors to normalize these factors across financial profiles. Yet, it fails to guide management of these SaaS companies on how to best balance the often competing priorities between rapid growth and increased profitability. McKinsey finds that barely 1/3 of software companies achieve the rule of 40. Fewer still manage to sustain it over time. Analysis of more than 200 software companies of various sizes between 2011 and 2021 found that businesses that exceeded the rule of 40 performance only 16% of the time, 1/6. There is also a weighted rule of 40 for public SaaS companies, because as I told you, not many are making it standard, and investors would privilege growth in that case to profit. But what is interesting is public SaaS companies scoring greater than 40% on a weighted rule of 40 posted an equity value divided by revenue ratio or multiplier of 22.4. Yeah. These high-performing companies would include Okta, Adobe, Zoom, Twilio, or Datadog. Further, each cohort above 10% on a weighted rule of 40 posted greater median EV to revenue multiples compared to the last quarter last year. That indicates the investors are favoring the growth stock in this year. But that might appear like, hey, what do we use it for, and how can we optimize our business? Because this is not guidance. All right, so McKinsey came up with interesting recommendation. First, realistic growth. McKinsey research found out that just 1.6% of the 200 software companies were able to sustain consistently strong revenue growth of 30% or more from 2011 to 2021. For example, when a $600 million SaaS company saw revenue growth begin to settle at 15% as it became a leader in its segment, management realized that they could no longer spend as freely as when the business was growing to 30 or 40% annually. So they adjusted their cost structure with the goal of generating 20 percentage point improvement in free cash flow over a 2-year period, taking it to 30%. That rebalancing will keep them at the rule of 40 and provide the means of them to invest in new high-growth businesses. The second one is net retention. These efforts, combined with strong pricing and product support, result in a median net retention rate, or NRR, of 120% or more, which means these businesses are able to deliver 20% growth every year without adding one single new customer. Top performers span different end markets, including companies. Twilio would have 139%, CrowdStrike would have 128%, and so forth. The analysis of 40 public B2B SaaS companies shows that those with an NRR of 120% or more also have higher multiples, with a median EV to revenue of 21-fold compared with a 9-fold for those below the 120% mark. This is because net retention is a core driver of growth and sales, as well as marketing efficiency. The third one is the go-to-market spend. Sales and marketing is one of the biggest expense areas for SaaS companies, amounting to 50% or more of revenue in high-growth businesses, where SaaS companies with the strongest EV to revenue multiples are able to recover their customer acquisition cost in under 16 months. Measured in terms of LTM median payback period, bottom quartile players take nearly 4 years to do the same. Top quartile companies also generate revenue growth 3.5 times faster than the bottom quartile. They define total opportunity using a retain, acquire, develop, optimize structure, also called RADO. RADO segmentation aligns marketing and sales efforts based on total customer opportunity. Teams retain accounts where the revenue growth opportunity is maxed. Develop accounts where significant upside do exist. Acquire net new accounts or net new logo that presents significant opportunity, and optimize net new accounts with smaller opportunity. And the last one is new business fast. For example, a $400 million SaaS company built a new $50 million annual recurring revenue ARR business from concept in 18 months. Given the challenge of maintaining growth over time, developing the capability to build new lines of business quickly is critical for long-term growth and value creation. Adapt fast. What is fascinating is that the SaaS business model now applies to a much wider range of industries and can propel a more sustainable way of doing business. Interviewed at the World Economic Forum, Philips' CEO explains how his company is innovating to embrace a circular economy business model. Their customers consume and pay for the use of their product as a service instead of buying the product itself. It is good for the environment, as products are designed for a much longer life cycle, brilliant for customer satisfaction and loyalty, and also appreciated by shareholders that can rely on a way more predictable revenue stream. This is one of the brilliant examples about how to make people, planet, and prosperity reunited. I hope you enjoyed this video, and if you did, please like it and share it. If you want to know more about this topic and many more, please subscribe to my channel, my blog, or my LinkedIn page. Links are in the comments to this video. Thank you, and see you next time.